Hello, everyone. Happy holidays. Welcome to another episode of Test, Optimize, and Scale. I've been looking forward to this conversation with Karl Dakin, capital coach, works with a volume of issuers of growth stage, even startup companies that are raising capital, designing, staging, managing, supporting the growth of these organizations. So you're going to hear firsthand stories, recommendations here today. Again, I know I have been highlighting this time on my calendar. Karl, thank you for taking the time to hop on the podcast.
Thank you, Jason. I appreciate the opportunity to be on your show and hope I can share some useful knowledge with everyone who's listening.
Absolutely. And already taken notes just in our pre-conversation launch in here. So confident you'll be able to deliver upon that today, and thought we could begin by familiarizing listeners, viewers a bit with your background, your story. How did you get into this position of working with founders, on their growth, on their capital raises?
Sure. I like to share everybody the short story, but I've been 45 years doing this, so there's really no true short version of it. But I grew up in an entrepreneurial family back in eastern Kansas. We operated a farm, a car dealership, and a farm implement dealership. So doing business every day, 24 hours by 7, was very, very common to me. And I joke I started my first business at the age of 7 because I was attending a 3-room rural schoolhouse, and I had the ability to go into town on weekends and buy candy at the drugstore, bring it back to the school and sell it at a markup until my business was shut down by regulatory oversight of certain parents and instructors.
Classic.
Yeah. So I got to understand a lot of the elements of the business and all the practicalities, the need to do what needs to be done to succeed. And that carried over to me deciding to run away from the farm and go to college, and then from college to law school, and then from Kansas to Colorado, where I now reside. And I've been working for 45 years, going on 46 here in a few days, where I've worked with startups and growth companies and community projects, charities, and so forth on getting going, getting started, making themselves successful. And I joke that I often drew the short straw, which is the person who had to figure out where the funding was coming from. So through many, many, many experiments with things that work and mostly that do not work, I've developed my own approach to raising capital, which I think has the most probability of success. I call it the motivated money method, which is what's swirled all behind me on the banner back there, in case I forget. But the idea is that there are people in the world who may need you to be successful in order to attain their own goals. If there are such people in the world, they are the ones who want to help you the most to get your funding, whether they write the checks or they introduce you to funding sources. They're going to make sure that happens because in their own self-interest that they need that to happen.
Yes.
If there are not such people in the world, your work gets a little harder, but they may want you enough. They may have enough benefit from your success that they still will invest in you for one reason or another. And at that point, of course, the work gets harder and more difficult, but nonetheless, we're both in the business of trying to find out who those people are and using different mechanisms, different techniques of trying to identify investor candidates who will write the checks, who will get behind the venture and move it forward. And there are several different ways of doing that, which work better for different people in different times and different locations. There is no one-size-fits-all panacea answer to that difficult question of who's my investor. Mm-hmm. And so always open to learning more myself and continuing to learn while I try to share what I have learned with everyone who wants to pick up on what I have to share.
I find those that are the best at what they do have that same sentiment of always looking to learn, always looking to do it better. Like you said, what worked, what didn't work, learn a lot more from the ones that do not. And I say that, and across the 500 plus deals we've worked on, I like the selling candy. I've heard that from other entrepreneurs. I was saying it's classic, and three-room schoolhouse, farm. Not in Kansas anymore. I like the road here, and the fact that you really try to break this down to a process, a methodology, because I find many groups in capital raising like to focus on their successes and make it sound too easy, right? Hey, these are the investors you want to reach. This is what's going to happen. And you're coming at it from a different school of thought in the sense of who is going to be in a better place because of your success. I remember learning about different types of investors that come into early stage deals far before regulated investment crowdfunding and was set, told, seed round, friends and family, maybe ROI investors, although they come with a string of difficulties, and strategic investors. If you could find a group that's going to benefit from your success, they may be the best company, the best individuals to bring on board. So interested to learn more about that interested to learn more about the methodology and tactics and how you figure that out. But, wanted to start by saying I think that's a great approach.
Yeah, so the learning process was slow because there's a lot of misinformation out there in the capital industry.
Sure.
A lot of myths, which may be true one day out of the year, but don't work the other 364 days out of the year. And one of the hardest ones was getting over the idea that people with money were smart. I somehow in there, everybody kind of kowtows and bends down to people with money. But the fact they have money doesn't necessarily make them qualified to be an investor, to understand the deal, to operate your business, or any of the other important questions.
Right.
And all too often, the people who are pointed to, such as angel investors, may have little or no training or skill or experience in making investments, which means pitching to them is kind of like throwing stuff at the wall and hoping something happens. And that's the way I view most pitch competitions and other things of that nature, where it's like I'm surprised anything happens at all out of those events.
Yeah, and I've heard of, the spray and pray type of approach, and I remember fundraising conversations back in 2008, 2009, economic events occurring and amazing startups with very little eyeballs around them, which prevented our abilities as marketers. That's where my background sits, is in marketing. Why I love advertising and these paid traffic sources where you can be very intentional about how many people you're reaching. But I remember hearing about these road shows or even local, LA. Hey, we talked to everybody with money. They aren't moving forward on the deal. It just may not be fundable. Where, like you're saying, it's a matter of finding the right individuals with the right messaging at the right time. Even finding them that one day could still make the whole exercise worthwhile.
Yeah, I work with what I call my concept of a funding soulmate, which is that there's someone in the world, hopefully not theoretical, somebody actually exists, who needs you so badly that they will do anything within their power to give you the funding you need for you to move forward. And I do this by going through what I call a stakeholder analysis, where I assume that in addition to a return on investment, which may be the only metric that most investors use when looking at a deal, is go beyond that and go, what else can you get or benefit from a deal? And this may be that the business sets up and creates jobs in the community, which would give the economic developers a reason to put money in. It may be that a supplier or vendor will be able to sell more product or services to that business as it grows. They will scale along with the business. Same thing on the distribution side. So we go through all this analysis and we try to find out, wow, this business actually has a greater impact at so many different levels beyond just ROI. And those differences may identify or point to a particular person, group of people who will have this greater interest because they go, that business is doing better for me than the next one who's also pitching for money. I want to move out of competitive analysis of everybody looks alike from the investor viewpoint to one of this business stands out, it has distinct characteristics. There are reasons for a conversation with this investor that will lead to a potential investment. And if we can achieve that, then by that definition, we have a reason to talk. And we still have to formulate our message. We have to craft an offer that's appealing to that person. There's a lot more work to be done. But everything starts with trying to find those investors who I consider most likely, most motivated to invest. And then we get into designing the entire capital campaign and everything that falls from that.
And so many founders want to skip these steps. They're just worried about the capital they're raising, cost of capital perhaps. They need money yesterday, and it's just a matter of what's being produced. When I find following these types of fundamentals can make all the difference in terms of their success. I've built a model for strategy called the 8-point plan. We usually do it over the course of 4 weeks, 2 sections a week, starting with industry analysis and competitor marketing audit. And when I tell founders that they need to be researching other groups in their space, they have answers like, we know who's, in our space, we know what they're doing. Or I could tell you just on the industry analysis part, where we're always coming up with new stats that could be used in the campaign to paint a picture of the potential for the prospective investors. Once we get to the competitor marketing audit, we're seeing exactly what their prospects, and I haven't even got the target audience yet, are going to be presented with alongside their opportunity. They're likely going to see ads. They're likely going to be retargeted. They're likely going to see these other offerings in the market, especially when we're talking about regulated investment crowdfunding. So I want to know what they're doing on social media platforms, paid and organic. I want to know how they're ranking on search engines, again, paid and organic. I want to know who's talking about them in the news. I want to know what their email newsletter consists of, what conferences they're speaking at, what podcasts they're a guest on. I want to know everything they're doing to obtain market share so that we're not just shooting in the dark. We're not just thinking, hey, we're going after smart audiences, so it's going to work. And then I formulate the target audience personas, profiles from there. I say personas, by the way, because I want to be able to, at least from a fictional standpoint and painting the picture of who this audience is with the persona, say, what do they do on the weekends? Where do they go online? Who are their biggest influences? What type of messaging are they converting on today? That way, what we put out can be as strong, if not stronger. So fully align with what you're talking about for the stakeholder analysis, for really understanding the path forward and determining who's actually going to care, and to the point of action once they get presented with a deal.
Yeah, I mean, unfortunately, this is a missing ingredient in most of the education on raising funding. But when an investor looks at a business and they're using a single metric, which is return on investment, they have, as you described it, lots of choices. And any other business who's offering the same projected ROI then becomes an apples to apples comparison. And anyone that's offering more is, in fact, considered superior despite all the other attributes that we want to talk about, which may be ignored because the investor is not that qualified in discerning between why these other attributes are important. So suddenly you're a commodity. You look like a lump of coal in a bin of coal on a train going by with multiple carloads of coal, and you all look alike because you've described yourself identical to everyone else who's raising funding. And at that point, you can only win by being lucky. Something happened that caused them to pick your lump of coal out of all these lumps of coal to move forward. So the things you're mentioning, where a person places themselves out there, they engage in media, they demonstrate who they are, they want to go beyond just talking about themselves to their benefits and everything else. There's lots of things they should be doing in that regard. But that starts to differentiate themselves. They're no longer the lump of coal at the bottom of the bin. They still may be the lump of coal at the top. But if they start looking a little bit different, this is something that an investor candidate can pick up on It may give them a greater sense that this group knows what they're doing. They're credible in how to conduct their operation. It starts building the trust that has to be established for an investment to be made. And if you're doing none of those things, then you really don't have much of a chance. You're playing a roulette wheel with about 7 billion slots in it, and you're hoping that the ball falls in the right one because you're trying to find somebody that may not exist.
Those are not great odds. Roulette on its own, I mean, we've
Yeah.
played and know how likely it is. It's exactly as you're saying. How do you make the coal appear more attractive and resonate more with the audiences? I love how you bring up jobs in the community. That could be geographical or the industry and benefit industry growth as a whole. I live here in Marina Del Rey in Los Angeles. Proximity has a power to it. If I'm prospected with an advertisement or some outreach messaging for an organization in Marina Del Rey, I'm going to pay far more attention. I will for Los Angeles as well, but again, Marina Del Rey, that's right down the street from me, most likely that they're headquartered. So I'm going to be looking at it further. And there's many issuers out there that are not looking at that type of target audience. Perhaps they are. There's many other categories that we could look at that could potentially resonate with them. Also, start getting into the topics of creative messaging, visuals, organic content, paid advertising. What's going inside those to establish more trust? Because I've seen double deals where the numbers look strong, they appear to be favorable, but there could be question marks on the team. Are they going to be able to get this project to the goals that that they're speaking to? That may be easier, with tangible assets, asset classes, in real estate as an example, but maybe much tougher if we're talking about, mobile software or something that has many variables in terms of go to market. So being able to showcase social proof and third-party validation. Look at these notable investors who've participated. Look at these publishers who have talked about the company. Look at all of these other validators to say, hey, this company's doing what they say they are. They're a moving ship. They're getting to their destination. You obviously have to be compliant about how that's talked about. But finding the right audience and speaking to them in a way that's going to inspire trust, confidence is really a big part of the digital marketing aspect.
Yeah, there's so much that goes into the message where you're trying to project yourself as not talking about yourself, because that's really kind of boring to most people. But
Sure.
you're trying to talk to the investors, though you're their advisor, you're assisting, supporting them in fulfilling their mission, their goals, whether they're personal or business or otherwise. And if you can start a conversation with, I think I know how I can help you along. I think I've got something that can get you to a point you would want to reach in your own life, however you describe that. Then you have a reason for the conversation. And then you can bring up the point that you can't quite help me as much as you would like because you're lacking some of the funding you're looking for. But if you start the conversation with, I need money, I don't think there's a shorter sentence that can turn the brain off as quickly as that statement. It's an automatic, like the thing when you watch TV and a commercial comes on. We're trained now to recognize it's commercial, probably because they elevated the sound level a little bit, but even the style and nature of it. And you automatically turn it off. You're not listening anymore because you've trained yourself to ignore it. And that's the way a lot of people respond to pitches, is you go like, well, why would I listen to somebody talk about themselves for 30 seconds or a pitch or whatever? But if you start off with, if you have a problem and I think I have a cure of this nature for it, then the person's going to pick up because they're going, oh, that's about me. Not about whoever's looking for the money.
Feature the function, talk about the value before getting to a call to action. I've had these YouTube video specialists on the podcast, and they speak about the hook. So few seconds on a problem, then a hook, and then the listening is much different once you get to the solution. There's a way to do it. There's ways I've seen that sound too opportunistic or too much like a sales pitch when speaking about investments in this fashion. But if we're talking about the market, the growth, the function of the product, the value that it has, as you mentioned, the value that it has to that individual, and then you're getting to a call to action, you could prime the audience in a different fashion.
Yeah, absolutely. I was exchanging emails with a young person I'm mentoring this morning. Mentoring means that he can't afford me yet. That's another story. But he was talking about investors being in one group and his customers in another group. And I said that if you have enough customers who want you, love you, have proclaimed their desire to pay high profit margins on whatever pricing you put, the investors are a consequence of that. Investors are looking for a huge satisfied market that's growing over time. That's the definition of a really good investment opportunity. If you don't have such a thing, then the most you can do is predict and envision and tell people great things are coming. And that's a much weaker argument than somebody says, I've already been there, done that. I've got people lined up around the block that want to buy my product or service. Oh, do I need funding? Yeah, I do, because I want to grow. And thank you for showing up. But you're now in control of the conversation because they're coming to you wanting to be part of your group instead of you trying to wedge your way into their lifestyle.
And I've seen founders look to build these relationships before the round even goes live. And I've had question marks from some of those companies of, why are we going to pitch investors before the deal's live? And I have to, emphasize it. It's not pitching the investors yet. It's relationship building. So if you are formulating these contacts, let's say it's on LinkedIn, and you're talking about what you do, and the prospective audience has a genuine affinity for it, by the time you mention to them an investment into the organization's available, once the round goes live, you're in a much better place, and it feels like a more organic, more authentic relationship. Even if they're asking you, to your point of, hey, can I invest in this? We have some things in the works. You got to speak about it compliantly. We'll make sure to mention to you, if we open up a round. I can't say too much more. Speak about it compliantly. But at the same time, if you have people who are waiting to purchase shares once the round goes live, and you have that immediate traction day one, week one, even if it's month one, it sets a much stronger foundation and puts you in a different trajectory towards success there. I also wanted to, point out that, if it's a strategic partnership, if it's there's this term, investomer use that you're mentioning, and not having those two different brackets, those two different buckets, if they are one and the same, there's all types of value that could come out of that relationship. It's not just focused on the ROI of the capital raise.
Yeah, I am doing a lot of work with crowdfunding. Most of it's at the Reg CF level, although occasionally I do a rewards campaign or even a charitable campaign.
Mm-hmm.
And when we do that, I'm trying to basically strike to the heart, for lack of a better description, and particularly with Reg CF crowdfunding, I'm a little bit of a contrarian because I am focused primarily on the customer. If somebody else wants to invest just on ROI, I'm not going to turn them down, of course. But I've got my strongest message if I can talk to the customer, because I have more flexibility in how I structure a deal. As I'm crafting offers to a customer, I have product or services that I'm selling. I might be able to throw that in with the investment where they're getting a little bit of equity or rev share or debt interest financing. I can also throw in discounts, and this is what I really love, because I can throw in like a 20% discount on future purchases that are 2-3 times the dollar amount of the investment, where it's totally in the control of the customer investor to exercise the option to use the discount. And if it's something they were going to buy anyway, then they are in control. They see the value. And this package now has an immediate ROI to them because they put in $100 and they get back $300 of product and discounts. It becomes a very simple formula for them. And most importantly, in crowdfunding is that crowdfunding was created primarily to allow the average person to invest in a local business. It wasn't really designed for angel investors or PE firms and so forth. It was to let the rest of us play in the capital industry by investing in our own backyard. And unfortunately, part is we don't have all the money sitting in a discretionary account to make an investment. So we have to invest out of our household budget, out of whatever we were going to go to the grocery or hardware store with in order to make our investment. And that means we look at, think at, and make our decisions differently than somebody who's using discretionary money. So offers have to be crafted to get into, should I spend money on this because I'm asking for this chunk of cash? Well, if I was coming out of my household budget, then I have the money. First question. Yeah. Second question, was I going to buy it anyway? Yeah. So now I'm saving money. This is good for me. We're starting to check a bunch of boxes. And because of that, we not only are setting up future sales with profits still built in, even if they're lower, but we're building consistency with the customer. We don't have to reinvent our customer every time because these people can stick in as long as those discounts and coupons are available. So we're building brand and all that. And that's where I work towards what I call the trifecta. I like a customer to become an investor, then to become an advocate of my business because they do hold a little bit of ownership in the company. They have every reason to tell their friends, neighbors, and associates, well, why don't you shop over here? And now I'm getting advertising when it's free or incentive. It doesn't really matter. But I've got one relationship instead of three. I'm not creating one group over here of investors and have to meet them, greet them, and encourage them to do all that. And then come spend that money to set up a new set of relationships with customers, and then get a third set of relationships to get people to promote me. So if I can do that within one relationship as a small business person, I am being ultimately efficient with my time. And time is ultimately the most scarce asset to work with.
It really is. Especially on these campaigns, I look at the timeline, and even more than the marketing budget at times. Respect to the budget, but the time is the most important asset. And if you're not bringing enough people to the deal with enough time to move forward, it's simply not going to happen. As a rule of thumb, statistically speaking, I love the idea of the trifecta. So not just the investor, not just the customer, but the ambassador. And I like it so much because I see it happen with the top issuers in the space. We're working with some of the top Regulation A+ issuers, Reg CF for the most part, but can raise up to 75 million. And when we're looking at those deals, they're groups that have typically already succeeded in Reg CF and have even run multiple Reg CFs and are now running Regulation A+ campaigns. One client we're working with, we worked on 3 successful Reg CFs, and the Reg A is now over 15 million. There's another one that did a lot of work before us, but they have over 40,000 investors at this point, and investors that are on the waiting list for their product, investors that are promoting the brand and repurposing the content when it goes out, and even peer-to-peer. And I'm the peer in many cases. I'll be at a conference. I've been at a golf course and playing with somebody who's invested in one of these deals. In some cases, deals that we promoted, and I'm listening to them before sharing that, and that they're directly acting as an advocate, a social promoter, ambassador, if you will. So I think that really is the ideal customer profile, being investor here as well. Any more information that you could share in terms of challenges that founders, CEOs face? I know this is a topic that you're writing about, and what are some of the common ones and recommendations you have around that?
Yeah, as I mentioned before we got into the show, I'm reworking the final draft of a new book I'm going to release called The Top 10 Challenges to Start Funding. And it's difficult because there's lots of things that could go onto the list, and getting to the top 10 is its own honor in a bad sort of way. But one of the most common things is that not investors, I'm sorry, but people seeking to raise money from investors, they get this idea like investors are something special. They're sitting out there waiting to pounce on a new deal, and their deal is somehow going to automatically attract it like a lightning rod, which couldn't be further from the truth. So the actual process, as we talked about earlier, has to be engaged in methodically, with intent, with targeting, with information along a path. Otherwise, the outcome is completely uncertain. And too often, a person ends up knocking on doors forever until they run out of money and time, and then their campaign fails and the business may fail along with it. So my first mistake I say most entrepreneurs make is they're talking to the wrong people. If you pitch to someone who's never going to invest, it's hard to justify any time or money that was spent in that particular pitch. And as we talked about earlier, a lot of people say, I want the money yesterday because they painted themselves into a financial corner. And it takes time to develop a relationship of trust high enough to get the investment. It takes time even to complete a simple transaction where they're already lined up to do it. And so you actually should be thinking about raising money the day you open your business, or even years before you open your business, and start building relationships, which all will contribute to people who know you, who trust you, who understand you, who have an affinity with you. And if they're not writing their checks, they are more than happy to introduce you to everybody they know, to create a super crowd, so to speak. Yes. That can bring enough people to the table to make an investment. So any small business owner, entrepreneur should be starting off with the question of who may legitimately invest in me, and they should start building relationships with those people as soon as possible and continue it until they decide they're never ever going to raise money again. And most businesses, that's a never-ending question. So we'll just leave it out there.
Always be raising is a saying I've heard quite a bit and repeated in terms of regulated investment crowdfunding. Was talking about some of those Regulation A+ issuers, and they're on their third, fourth, eighth round. So I do see the need to continue going back to capital. Conversations. Perhaps there's an exit strategy. We've worked with groups, this year that have run a successful Reg A and in path to going public, and different types of liquidity, different types of access to capital, perhaps. What other tests would you recommend? I look at marketing as a series of tests. Marketing the deal, could be marketing for growth at that. Absolutely agree, and it's similar to things that I say in terms of first of all, raising money day one. I really like that. You started the company, put in the seeds to sprout those relationships at a later time. Figuring out the who and figuring that out early, determining how this could build over time. What are some other tangible things that could take place beyond that relationship development and early on towards the success of a capital raise? What are some things viewers, listeners can do on their own after listening to this podcast?
Yeah, well, they should step back from what I call a generic offer. I'm going to give 20% of my company for X number of dollars. That's the same offer everybody else is making, and everybody's going to hold you then to differentiate yourself on return on investment, which may be impossible for you to do. You've only got so much profit, so much sales to work with. So how else can you distinguish yourself? And so when I'm talking with prospective investors, I've already kind of zeroed in on I like to ask one more question, like, what else can I do to my offer to make this a deal you can't walk away from? And it may be highly personal, like, oh, you got backstage passes to a band coming through town. It may not be anything that looks like it's rationally connected. But by asking that question of what else can I do to make my offer better, you have demonstrated respect for the person you're talking to. You're concerned about how you can relate to them and support them and what they're doing. And quite often you can find things you can do for them that cost you nothing. It may be a non-monetary type of thing to add to the package, which is, oh, I'm going to do a shout out for you in my next TV show, or I'm going to do something else. But it's always striving to make it almost a custom fit offer for each and every person you're talking to. And yes, you can't do that for everything all the time, everywhere. But every time you talk to an investor candidate, or even before you're raising money, you're framing your offer, you've identified 5, 10, 1,000 people who might have an affinity with you. Ask them that question. What else can I do to make this a better deal for you? And it will sharpen your understanding, your relationship. It will build that trust that you need to have at the time they make a decision to invest. But it'll make you different. It'll separate you from the crowd. It'll put you out where people can see you and give you a form of superiority, which is based upon who's going to generate the most money, but who cares the most about the investor candidate.
I think that's such an important thing to mention. And again, doesn't always take place, especially you're putting together an offering page on, let's say, a Reg CF campaign. You're not necessarily speaking to all the investors, and you may think, hey, this is a stronger version of my pitch deck. The numbers in there stand out. We've got a good video, good social proof, but we're not getting the conversion rate. We're not getting investors to move forward at the level that we want or projected. So investor feedback is something that I'm hearing in there of closed loop. Let's not just paint the picture of smart money and who's going to invest and, people with wealth. Let's actually ask the investors, what do you like about the page? What do you not like? What would you need to see to physically move forward? And I'm partially asking so I could shape my offerings, not just to get you to invest. But like you said, by doing that, you differentiate yourself and are creating more of that authenticity. Like it a lot. What about optimization in general? Not all marketing campaigns work right out of the gate. Many do not ever. Not all capital raises are successful, and especially not in the first month, let's say. How do you optimize a campaign if it's not producing the results in the first few chapters?
Yeah, if you're not getting an immediate response, then you're dealing with bad information. You've created an assumption in your mind about who you're talking to, what goes into the offer that's attractive to that investor candidate, how you're communicating, where you're communicating. There are many variables, but they get down